Well, good morning, everyone. My name is Nancy Easterbrook. I am Executive Director of Silicon Valley Directors Exchange. Welcome to our webinar this morning, Spacs, Here to Stay. SVDX is an organization for educational and networking programs for directors in the Bay Area. We welcome you to visit our website, www.svdx.org. I'd like to thank DLA Piper, who is our co-sponsor for today's webinar. And it's my pleasure to introduce our speakers today. Dr. Raluca Dinu is Managing Partner, CEO, Board of Directors member at Gig Capital II with over 20 years of achievements in the high-tech industry. Priya Shireen Huskins is Senior Vice President, Management Liability at Woodruff Sawyer and a recognized expert and frequent speaker on D&O liability risk and its mitigation. Eklavia Saraf is Global Head of Spac, Managing Director of New Listings at NASDAQ with over 10 years of capital market experience. Jeffrey Selman is a partner at DLA Piper, representing emerging and middle market public and private technology and life sciences companies and investors. And our moderator for today, Daniel Siciliano, is a successful technology CEO, founder, and entrepreneur. He's currently chairman of the board of the Federal Home Loan Bank of San Francisco, chairman of SVDX, and a fellow at Stanford University. Today's webinar will be 1 hour long. We will have the presenters speak for about 30 minutes and then dive into the Q&A. We welcome you to use the Zoom feature of Q&A in order to submit your questions. And additionally, we will be recording the session for later viewing on our website. And with that, I will pass the baton over to Dan.
Great, Nancy. Thank you very much. We're really excited for this webinar. We're going to try to follow our traditional format and keep the presentation, the formal part, to hopefully well less than half of the session, and then switch to Q&A from all of our attendees. And so with that in mind, I think we're going to kick it off, Nancy, if you don't mind, with a poll. We wanted to get a sense of why people are showing up today in such fantastically large numbers. We try to often cap our sessions, but we'd let this one go to a larger number. So we're interested as to why you're interested in SPACs. You have 4 choices. You're an entrepreneur, actually interested in an alternative to IPOs, perhaps a board member or board member candidate considering serving on a SPAC, or maybe an investor or VC looking at alternative capital raising IPO strategy. So let us know. That'll help us steer through the several choices we have as to what our discussion might be. I'll give you another few seconds. Don't be shy. It's anonymous. Don't worry. We won't rat you out to partners, other investors, or what have you. Nancy, you tell us when you're ready, and let's put it up there. Okay. We have a wide mix. Ooh, we'll have to figure out what that other is. So we've got some entrepreneurs. We have a lot of board member candidates and board members. That's great. And then perhaps some investors and VCs looking for alternative strategies. All right. Thanks very much. Well, why don't I first turn to Jeff and ask a basic question. I suspect we have a wide range of knowledge on the among the audience members. And so can you maybe in like about 3 minutes, and I'm sure we'll expand on a little, tell us what is a SPAC and how does it work?
Sure. No, thank you, Dan. And let me, hopefully this is going to work here as I try to share the screen. Hopefully people can see this slide that we put up to try and really sort of explain a SPAC. Best way to think of it is it's kind of like private equity, but where you raise capital, but it's not because it's public. And so what it really is, and as noted here, it's fundamentally a big pot of money. So if you look at the circle up on the upper right-hand side, a sponsor group, investor group forms a SPAC, puts about 3 to 5% of capital in for approximately 21.5% ownership of the company that does an IPO, and raises capital, which is the dark blue in that oval that we have up at the top on the right-hand side. That then sits as a blind pool of capital for anywhere from 15 to, let's call it 24 months, as that blind pool of capital goes off and looks to find a operating company to take public. And that's really, at the end of the day, what a SPAC is don't think of it as an entity, think of it as a vehicle for getting an operating company public. that's different than the other ways to get a company public, a traditional IPO, a direct listing, and that's really what this is. As noted, the red piece, which is that sort of 3 to 5% of capital that comes in, that's really used for paying both the offering expenses of the SPAC's IPO, as for raising the remainder of the capital, as well as working capital for purposes of going off and finding the business combination. Let me see. Hopefully, this will get us to the next slide here. And then sort of continuing with this, as we talk about and we think about sort of the timeline of the existence of the 15 to 24 months of the SPAC, running down the left-hand side, sponsor forms the SPAC and conducts the IPO. That process typically probably 75 to maybe 90 days, so it moves very quickly for raising what today is probably averaging $225 to $250 million, although that may have ticked up. I can tell you a year ago, I would have said $175 to $200 million was the average size of a SPAC. And with the plethora of SPACs that we've had the last 2.5 months, those numbers have really gone up. But if you think about that, to be able to go from start to having a pool of 225, 250 million or more, that's a very quick time frame. Then really sort of starts the what I'll call the long slog. And I know Raluca can sort of talk more about this, but it's, as I said, sort of going off and looking for acquisitions, looking for a target to acquire. But it's really not, people don't think of it as an acquisition. It's really a business combination. I like to describe this at the end of the day as a capital market event for the target company disguised as an M&A transaction. But you're looking for the acquisition target for a business combination. Once you have that, then you enter the de-SPAC process, which is both securing the cash that's going to remain in the combination, as well as going through the SEC proxy process. Last thing here, sorry, go to here. Best things to sort of think about: what's a SPAC used for? It's really used, good for getting a business that is an operating company that ought to be public, but might not otherwise have a path to get there public. That means you need to have a company that's ready to be public. A company that's just completed its Series A, probably not, and is pre-revenue, and absent very certain circumstances, probably not the right thing. A company that's not really going to have operations, again, probably not the right thing for a SPAC. Or if you have a path to getting public through other means that the economics make it more sensible to go that way, probably not the right thing for a SPAC. But from the perspective of why a SPAC, you invert in some ways a lot of what you're doing from a pricing standpoint. You can get pricing certainty earlier in the process than at the end of the day after a roadshow, as you would with a traditional IPO. And depending on how the deal is structured, or the value that's being given to the company, the economics could pencil out to be much better from an economic standpoint when comparing for example, commissions you pay for underwriters versus what you're giving up to the sponsor who holds 21.5% of the SPAC. So with that, I will stop there and kick it back to you, Dan, and just let me know if you want me to leave the slides up or not.
I think you can take the slides down, and thanks, Jeff. That was a kind of crash course in SPAC fundamentals. Let me dive in and synthesize a couple questions that have come in. So first, can you define just quickly for us, and maybe I'll turn to you, Raluca, on this, like who are these players again, just as kind of a review. So there's the SPAC sponsor who becomes the SPAC. So who is that? And then maybe say who are the investors typically or technically, and then where does the target or the business come up? And maybe there's other players. So do you mind running us through for like a couple minutes the who is playing in here?
I would love to, Dan. Thank you so much. So at the beginning of it, there is a group. In the case of G Capital, for example, since it is always easier to relate to concrete cases, we have a group of 15 executives, Bay Area executives, that participate as sponsors into GIG Capital 1, GIG Capital 2, GIG Capital 3. To your point, the first phase of the SPAC process is the IPO. So you, as a group, once you define your charter and what you'd like to address, we are looking into TMT targets, not necessarily wider than that. We are very focused on the TMT space. But to extend the comment today, there are about 157 active SPACs, and 122 of them are looking for targets. More than 60% of the very successful SPACs are coming from the TMT vertical. So as you're going for money for the IPO, for the first stage of the SPAC, you will have investors coming from fundamental or long-term investors segment, or you'll have investors coming from with a charter of yield, so shorter-term investors. As everything comes together to an IPO moment, the book can be 100% formed out of the yield investors, or can be a combination of the long-term investors and yield investors. Once the IPO is completed, the search for the target starts. And that's the fun part, in my opinion. Why? Because you are meeting a lot of teams. They're coming from the same background as us. We are we've been executives, operators in the space, and it's always a pleasure to meeting those teams. They have big dreams. To Jeff's point earlier, they either are at the discontinuity point where they see a tremendous growth in the next year, and SPAC provides the ability of sharing the financials, the projected financials. So those groups can show we have grown till with a certain percentage up until now, and from this point on, there is a discontinuity in the business, and we would like to show that to the investors so they can properly appreciate the business. Or other situations for the company to become public. Maybe they would like to have the cash to be able to grow the business organically or inorganically. So that's at least in my opinion, that's the most exciting segment for the SPAC. And once you decided that the target is the one that you would like to take public, and it's the whole diligence process was completed, you go into more of the mechanics for the D-SPAC and making sure that the S4 goes to SEC and the target is taken to the public market.
And let me jump in there, Luca. Let me ask, thank you. That helps understand kind of the flow and who the players are. In a moment, I'm going to turn to the question of riskiness and director roles, and so I'm queuing Priya up. But let me ask a synthesized question that's come in, and I'm combining several of them, including a question that says, hey, Renaissance Capital points out that the performance of SPACs from 2016 forward hasn't been as good as traditional IPOs. And then I have a whole set of questions that go something like, well, wait a minute, what do you need to have in order to be a successful SPAC? And if you were kind of IPO ready, why would you choose this path over a more traditional path? And a lot of the questions come down to, all right, what's the gimmick here? Like, why do companies choose to go? Is it because they aren't appealing in a traditional IPO, or there's more risk, as Jeffrey alluded to, or is it because it's actually a little early, but they're trying to take advantage of a moment in time? So here's my question to, and Priya, you should feel free to jump in, but I think I'm gonna ask this to Clavia, who I believe is on the phone, and NASDAQ's in a position. What is the differentiation, in light of what I just laid out, between those who come forward as potential, companies that are eligible as targets for SPACs versus a company that might want to, eventually go through a traditional IPO process? What is the differentiation right now, other than as an entrepreneur, I'll say, any chance of liquidity or capital that works, you look into it, right? So I'm not faulting the investigation. So Clavia, what is the difference between the companies that you say, oh, no, go talk to my colleague over there, traditional IPO, versus glad you're chatting with me, let me introduce you to some SPACs? What's the difference?
Yeah, so I would say they share very similar characteristics in the 2020 marketplace. So just to give you some context, previous years, the SPAC raise, and I see Raluca smiling because as you can look at it historically, her firm's done a great job of going with the times, right? So a few years back, SPACs accounted for single-digit percentage of the capital raised in the IPO market. This year, and I'm probably misquoting myself because it changes on a daily basis, I feel like, it's probably above 35%. We're probably going to get closer to 40%. So a significant amount of capital being raised as a SPAC. So the key differentiation between a target that can be acquired by a SPAC and one that will go public through the traditional route, that's kind of being convoluted. The worlds are meeting together. The worlds are meshing together. And the way I would think about a SPAC offering in today's marketplace is there's a traditional IPO. We all know how that works. There's a direct listing, and now there's a direct listing plus where you're going to be doing a capital raise alongside that. And NASDAQ is on the forefront of that and has applied to the SEC, and we're awaiting some guidelines. And then there's the SPAC market, which we've done over $39 billion since 2010 and 84% of the business combinations. The worlds are colliding. So I would say previously, there were certainly some companies that really wanted to be specific to what the SPAC was being specific to. So some SPACs launched as a energy-only SPAC. Some launched as a healthcare-only SPAC. We're seeing more of the themes emerge in 2020 where they're saying, we're going to just focus on tech. We're just going to focus on healthcare. We're just going to focus on energy. And so what I would say is every company today that we are speaking to about an IPO has already probably been approached by a SPAC. It's just how the numbers work. And so that differentiation is no longer there as far as what companies are better fit for SPAC versus an IPO. It's which one is better prepared to do either. And I would say the SPAC is not an easy way out by any means. I mean, you have to meet the same regulatory requirements from the exchange that the SEC mandates. You have to meet the same accounting standards. You have to meet all of those standards because if you're not prepared as a public company for that first earnings, quarterly earnings call, you're going to be in the penalty box for 5 quarters, right? So you have to be there and be prepared. And I think what's very unique about the SPAC product is you have former board members, you have former investors, you have former operators, former founders, former CFOs, all forming these SPACs and getting together with the target company and offering their insights. So let's take Nikola as an example. We're extremely proud to be a partner. Steve Gursky is formerly on the board of GM. He raised the SPAC. He was able to get a tremendous amount of support from the PIPE investors, combined it, and he's offering, guidance and insight. And now you saw the stock pop with the recent announcement of the GM deal. So it's certainly, I think that's a great example that showcases what's happening today. So short answer is the worlds are colliding. We're seeing that SPACs are being spoken to by many different angles. And we think that it's great that there's a diversification and an exit strategy in this marketplace so that the founders, the early stage investors, and more importantly, the future investors can best be serviced by the right strategy.
Got it. And we're going to come back to all of these topics, but I'm just trying to seed them and then we'll go to general Q&A. So I'm actually going to ask Nancy to go ahead and queue up our next poll. We're shifting gears a little bit. I want to talk about directors and kind of the downside risks and other issues. So here's the question, serving on a SPAC board. My gut tells me that serving on a SPAC board is a lot riskier than serving on a typical public company board. Well, we just want to see what you think about that statement. So you might strongly agree, neutral, disagree, strongly disagree. Let's have the participants weigh in. And then Priya, I'm going to turn it to you. I'd like to have you give us a quick overview of the kind of exposure liability landscape of SPACs, but more specifically directors serving on SPACs. Maybe draw on your many years of experience. And if you don't mention it, I'm going to ask you to talk about insurance. But we can come back to that if you like. Let's see what the overall responses are. Okay, so kind of a broad spread here. We've got some people strongly agree. Most everyone agrees it is somewhat riskier. Some neutral, and then some what we might characterize as optimists saying, no, it's not riskier, or I really don't think it's riskier. All right, so with that in mind, Priya, why don't you give us an overview of what you think? You are muted, but it sounds
Yes,
good.
this is my very first Zoom call today. Sorry. I'm new to Zoom. So when I think about the litigation environment, I think it's useful to divide it up into 5 categories. And I will go through them quickly, I promise. The first is the SPAC IPO. And that is a surprisingly low risk environment for directors. That also makes sense, right? There is not a ton going on in the S1, no disrespect, Jeff, right? But it is a slim document with few opportunities for plaintiffs to cry foul compared to the S1 of an IPO for an operating company. So to date, I have not actually found even one securities class action lawsuit that relates to a SPAC IPO. If somebody has one, please send it to me immediately. But I've looked and I haven't seen any. Now, human nature being what it is, I also have tremendous confidence that between now and the end of time, some bandit or fool will cause us to have one, but it hasn't happened yet. So that's the first category. And if you are a director thinking, should I be on the board of a SPAC IPO? Yeah, of course, you need to have insurance to make sure that you have a pot of money to defend you if there's a problem, if the SEC gets involved, something like that, and for other reasons that we'll talk about downstream, but it's a pretty low risk environment. Second category, M&A. There have been limited instances of litigation associated with the actual M&A relating to is the transaction itself worthwhile. That looks exactly the same as all merger objection suits. People who are in the world of M&A see these all the time. Those go away for actually very little money. They're not very interesting. They're also unlikely in this context because of the way redemption works, right? The shareholders of the SPAC can redeem instead of going forward. But
could you actually, I'm jumping in, could you take 20 seconds to explain that? Because if you're not familiar with it, it's a confusing feature.
I actually think Jeff is better positioned. He'll be more accurate.
Yeah, happy to take
20-second side, and we'll go back to Priya.
Yeah, happy to spend a moment on this. And part of this is the dynamics of the parties to the transaction. An important thing to sort of understand here is, so the public company, the SPAC, which is sitting on that pot of money that I talked about previously, probably the most important thing to understand, every SPAC raises cash for that pot of money at $10 a security. That's just the price, unless you're Bill Ackman, in which case it's $20. But it's $10. It's $10 per security, and that $10 goes into a trust account, earns treasury rate of interest, currently trading at about 12 bips, so not a lot. And when the M&A transaction comes along, is 100% redeemable by the holders of the public security. So if the holder of the public security doesn't like the deal that's being put in front of that holder, they can take their $10 plus 12 bips of interest out. So there's the risk from a legal standpoint, therefore, is really very much mitigated for the public stockholders. And then you flip to the other side of the coin, where you're taking a company that's not yet public. Presumably they have a reason for wanting to go out as that public entity, or else they wouldn't be signing the agreement. So again, from a legal standpoint, a fairly low risk.
So the point being that all things being equal, as a shareholder, if you don't like an M&A deal, you will just redeem. Why would you bother suing and getting cents on the dollar? You'll actually just get your shares back. So no surprise that we don't see a ton of litigation there. But now move forward, the deal has closed. Shareholders who decided to stay in did stay in. And sometimes that goes badly. And in fact, of the 93 successfully completed de-SPAC transactions from 2015 through August of this year, of those 93, 5, or about 5%, has seen M&A litigation on a post-close basis. It is notable that 4 of those all were deals that happened towards the very end of the SPAC's life cycle, and we should all take note of that. The last category, just to be complete, last 2, one as an operating company, right, the go-forward company, hey, no surprise, you're doing earnings, you're doing guidance, you can get sued just like any operating company can. And then the last category is, of course, corporate bankruptcy, and bankruptcy in its various forms has the ability to go back and hit the original sponsors. So when you think of that 5 pillars, and we'll send an article afterwards that gives you the 5 pillars, so please don't feel like you have to write frantically. When you think about those 5 pillars, It's almost no risk. There's never no risk, but almost very low risk for the director sitting on a SPAC IPO. But the show is what happens after the money comes in. And Raluca talked about it as the exciting time. It's also the time where, as a director, you have to pay attention. You have to be looking very seriously at the deal, and presumably you're on the board because you have that skill set. I would encourage you to have a record of your exercising that skill set as you go through the process, in case you end up in litigation later over the deal.
Yeah, that's great. Thank you. We'll come back, I think, to some of the additional strategic remedies for if something does go wrong, if you don't mind kind of expanding on those. Let me ask a couple other questions that are floating around. And I think anyone can pick this one up, but what do you think about the fact that if we end up with direct listings plus, right? So the modification of direct listings to be able to actually raise money, is that a substitution or a competitor for SPACs from the kind of business side, from the target side? And does that change the kind of game moving forward? Does that make SPACs less relevant, or are there still reasons why we think we might see the current flow and rush?
So just from a liability perspective, which is probably the least interesting perspective, let me just say quickly that IPOs get sued a lot. So if you look at public companies last year, 5% were sued. That is a 10-year high. If you look at IPO companies, it's 3-year statute of limitations. So the class of 2017, the IPO cohort that went in 2017 is pretty mature. That is closer to 13 to 15% of them have been sued to date. So IPO companies get sued a lot. It's a very desirable type of litigation from the plaintiff's perspectives. There is nothing about a direct listing, we are all disappointed to learn, that changes that game. Quite the contrary. We see litigation in the same way. It's very problematic, very expensive from an insurance perspective. I just told you that the de-SPAC transactions, we see some litigation, but it's mitigated compared to IPOs. So the litigation environment is expensive, it's distracting, it makes everybody very cranky. And so just right out of the box, the litigation environment is much better for SPAC transactions compared to everything else.
Flavia, do you mind weighing in on that a little bit? I'm going to tag one additional comment from you on it as well, which is, and Raluca, feel free to chime in. What about timing as well? Maybe do a compare and contrast. Like, depending where you look, you see, and this was a question that we received, you see, oh, it takes 4 to 6 months. Then someone claims, no, it can take 7 to 10 weeks. And so could you answer this direct listings plus feature difference and then maybe address the timing as well? Then I'd love to hear Jeff and Raluca weigh in on the timing as well, because that tells a lot about the process. Flavia?
Yeah, Raluca, do you want to start with timing, or do you want to start with the previous question of kind of the direct listing stuff, or I can kick things off as well. I'll leave it to you.
You go ahead, Flavia. I'm reading her lips.
Okay.
She said you.
Okay, so I would say on the direct listing plus, I think it remains to be seen. There's still a lot of regulatory framework that needs to be implemented. So it's fairly early to comment on that. What I would tell you is we're always in the forefront of innovating with new kind of services and solutions to the capital marketplace, and we're proud of that. What I would say is, people are asking also, is this kind of the ninth inning of SPACs? We're seeing so many being raised. I think people are realizing the potential for SPACs, frankly. There are sponsors, venture capital firms, family offices, there are private equity investors that are just realizing that the advantages of a SPAC, and some of those we haven't touched on, frankly, that I think are, you could not touch the dry powder that you're sitting on from your LPs and raise a SPAC as a separate vehicle and, have a different strategy for your SPAC type of investors without touching the dry powder you're sitting on with the amounts that you've raised. So that's one clear advantage. So I would say it augments the process today. And I think as more options become available, you've got different products and services and solutions to the capital market ecosystem. And so I think it actually opens up the world a little bit more, as opposed to, creating a conflict, so to say, between one product, which is the direct listing plus, and the SPAC. Again, that's the kind of glass half full perspective that I think we all appreciate. So I think it's a beginning, and it's a way to augment what's already out there. So I look at it from the perspective of more people getting involved, more options, and that options have a better fit for the different kind of goals that people have in mind.
Got it. Thanks.
From
What
a
about
legal
this-
standpoint, just to throw in something and then for Raluca to sort of also comment on, one of the key distinctions that I see is that's made available is because, as I said at the very beginning, this is a capital markets raising event, but it's disguised as M&A transaction. Because it's an M&A transaction, forward-looking projections are available that would not otherwise be available with regard to the traditional IPO, and presumably not in a direct listing plus. So there's information that can be gotten into the market that can help facilitate. I mean, this should be thought of as not the end of the end event liquidity, but rather the beginning event. Being a public company where ultimately you want coverage to be able to help facilitate the trading of the and liquidity of the stock. And so being able to get the information into the market earlier, which from a legal standpoint you can with a SPAC, I think is a key consideration. So with that, Raluca, sort of how that sort of factors into timing and structure.
Yeah, Raluca, tell us more about, especially about the timing.
Yeah, right. So I cannot agree more. Both Jeff and Claudia gave you the dimensions and the differences between the two. There is space for both. There is a certain crowd for each one of the two instruments. In terms of timing, the SPAC takes about 4 to 6 months from the moment you have everything in place. I would love to hear the argument for somebody that says it's 5 to 7 weeks. We would love to do it faster because there are a lot of targets at the very good companies at this point in time, and there are a lot of SPAC sponsor groups that are looking for very good combinations. It takes time. In regard to the differences between the direct listing plus and the SPACs, Jeff nailed it. I say the most important characteristic of the SPACs, besides the timing to the IPO, is the fact that the company can show the forward-looking projections. Extremely important because it covers a segment of those late growth companies that could not get into the public market without showing this forward-looking projections. And we can relate to that in all the segments, more so that we see some sort of a clustering of those verticals for the targets. Lately, you have a lot of gaming companies that are becoming public. You have a lot of companies coming from the auto vertical or the electrical. I mean, to Claudia's point, Nicola is a tremendous success from electrical vehicles vertical, or from the food industry, and on and on. So clustering and financial projections, the ability of showing financial projections is extremely important. And to Claudia's point, there's a category for each one of those instruments, and the target team has to choose whatever is aligned with their dream, and whatever, to Priya's point, whatever fits the particularities of that legal and path towards the IPO.
So let me ask a follow-up that actually might create the opportunity for exposing the misunderstanding about timing, and that is, so if you have the SPAC up running, fully formed, and later you identify a target, what's the probable expedited but not crazy time frame from that moment? So you have the dry powder, there you are, you've been at it for a while, hopefully not near the end of the life as Priya described, where you have more risks, and you say, this is the target for us. How long does that take?
So Dan, there is one long pole that you always have to consider in this process, and it is usually the audit. I can tell you, for a company that we have taken public in our first SPAC instrument, Gate Capital One, it was an Italian company. It took about 5 months to complete the audit because of various business units that were acquired in the last few years, and on and on. So it can take a long time. If the company is ready for it, and if the audit is completed, and Jeff can relate to this, if he can hit the ground running and put the S4 in place, should not take more than 4 to 5 months.
Yeah. So one thing I want to make clear, and I saw that we had a question to this on this part to begin with. So from a legal standpoint, when the IPO is being, when the SPAC is being formed and going through the IPO process, there cannot be a target in mind. So there cannot be any target identified, selected, contemplated until the dry powder is in place. 5 minutes after the wire comes in from the underwriters on that IPO, you're off and running, but you're not until that point in time. And that's a very important thing to understand. And that starts a clock. And every SPAC has a clock. They could be as short as 12 months, but typically it's not shorter than 15. Rarely longer than 24 months. And time frame can be extended, and there's paths to be able to do that, but that's during the process. So it really, though, part of what you're looking at when the SPAC is being launched, and that investors in the SPAC IPO are considering, notwithstanding the fact that they're able to redeem the cash, is this a management team of this SPAC who's going to have the ability to get access to deal flow, knowing that process doesn't begin until then? And how likely are they, one, to be able to get access to that deal flow, two, have quality companies that they're going to be looking at that really are IPO, public company ready companies, and that ought to be taken out by way of a SPAC, and three, be able to get the de-SPAC process, which is probably the most challenging. Priya made the point, and I took no offense on this one at all. Yeah, the SPAC IPO is not difficult. The fact that in 2019 was a record year, there were 59 SPAC IPOs. In the months of July and August of this year, there were as many SPAC IPOs those 2 months as there were all of last year, and I think I saw 6 filed yesterday. 5 the day before. So we're at a tremendous pace. And if you think about, as I said earlier, we've gone from averaging $175 to $200 million per SPAC IPO to probably 225 to 250, maybe higher at this point. And you multiply that times 59, 60 SPACs in a 2-month period. That's a tremendous amount of capital being raised in a very short period of time. That's not the difficult thing. The difficult thing is the deal flow, and the real difficult thing is the de-SPAC.
So let me ask, I'm switching now to channel kind of all the questions that we've been getting. I'm synthesizing several, but let me post some directly. So who is the typical, or what is the typical profile of a SPAC sponsor? Luca, you alluded to it. Jeff, you've said some things, but can you give us like a 30-second concise answer? And it's okay to say we don't know anymore because it's evolved so much, but maybe some hint.
I'm seeing a mix of a lot of different things. People who've been operators, entrepreneurs, such as Raluca and her team. Private equity, a lot of private equity funds have come in to form SPACs, or venture funds and the like. So people who actually have experience with deal flow. Investment banks. This year alone, we've seen Roth Capital and Craig Hallam did the Roth CH SPAC. B. Riley did B. Riley Principal too. Or former executives from investment banks, and so those tend to be the most common that we see.
Great. Yeah. Related to that, maybe this goes to Priya. What liabilities does the SPAC sponsor face? Is that different from the liability that you described? And we've received several specific questions, not all of them planted either, about what's the D&O market insurance IPO versus SPAC? Is one more expensive? Is one less expensive? We already got the profile and litigation. So can you tell us just a little bit about that, Priya?
And just in terms of the SPAC sponsor versus the company that's going public, sponsors of any transaction, the original people putting up the money will always create a vehicle that is intended to shield them from liability, and there's a theoretical control exposure that, again, we've just not seen any. There's so much low-hanging fruit for plaintiffs. This is not worth, it's not a compelling case for them. We haven't seen anything like it. Having said that, certainly all of our venture and private equity firms that are sponsors have a kind of insurance that will protect the sponsor should it come up, just like it does for any of their other investments. And that's an important part of their risk mitigation strategy. Turning specifically to insurance, there is an enormous gap in pricing between a SPAC IPO and an operating company IPO. And to set the stage, I can share with you that last quarter, the average, so just average cost for the first $5 million of D&O insurance for an IPO, an operating company IPO, was over $1 million. And if that didn't take your breath away, you're not paying attention. And I want you to hold on to something when I tell you that that was over on average a $13 million self-insured retention. So for the privilege of the first $5 million of insurance for an IPO, you would have to first pay $13 million, and then you would get the $5 million of insurance that you got for your premium that was over $1 million. So that's super bad news. Compare that to a Spac IPO, and with the joy of anchoring, you will love whatever I now say. And the answer is the equivalent self-insured retention deductible between 1 and 1.5 million. And the vast majority of Spacs will buy 20 million of insurance. And that 20 million of insurance will be, let's call it between $450,000 and $475,000 for 20, not for 5. Now, that number I just gave you is a number that is higher than if you had asked me this question in January or in the middle of last year. And that's a question of insurance capital. The other thing I should have really emphasized is that $1 million+ for $5 million for an IPO is for one. But the Spac IPO number, the cost for the insurance is a 2-year number, right? So it's even less expensive on an annualized basis, but that also causes a problem. There are not a ton of D&O insurance carriers that are able to write a 2-year program because of reinsurance issues. And so Jeff alluded to the numerosity of Spacs, and the reason the prices are going to go up now and have been is because there's limited insurance capital. All the numbers I gave you are also related to domestic, U.S. domestic Spacs, somebody with at least a U.S. address that's credible. If you are, it's Cayman-based and Singapore-operated Spac, that is a lot more expensive, just a lot more expensive. So the numbers I'm giving you are very much domestic. I would note that for those of you that are now looking at Spac S1 registration statements and are looking at the expenses and are wondering what's going on because the numbers I said are less than what you're seeing. Yeah, I don't know what's going on there. My numbers are right. And a lot of S1 registration statements for Spacs indulge in a ton of copy, paste, revise, and very often that number isn't changing. So just from the outset, from the sponsor perspective, the Spac insurance is getting more expensive, but it is less expensive than an operating company IPO.
Thanks, Priya. I have a grouping of questions that go something like, can a Spac target a public company? Can a Spac acquire a portfolio of companies? Can a Spac do a public and a private company? So I would like someone to jump in and maybe address that. And then there's a follow-up question, which is, how often does a Spac not acquire anything? And what happens at the end of that life cycle, assuming they don't do what Priya warned against, which is kind of scramble or something. So Jeff, you want to take a quick stab at that, and maybe we can have
Yeah. So the very quick answer to all of those questions that you first asked is yes. And for a little longer explanation, look, I mean, we see whether you wouldn't take a company that's already listed on the NASDAQ public on the NASDAQ because it's already listed on the NASDAQ. But for example, my firms, we're currently working on, and this is publicly announced, a transaction where Tel Aviv Stock Exchange listed company is being moved to the United States to be listed on an exchange here. So that's, you see things like that. And portfolios, yes. I mean, roll-ups, Raluca can speak to this. There's a lot of activity where people are looking and saying, we can put these 4, 5, 6, 7 companies together and have a really interesting sort of roll-up transaction and get it financed, but trying to get that financed in the private markets is difficult. But if we utilize the Spac as a vehicle to get access to the public capital to do that, it becomes viable. Those are very common types of Spac transactions. And so for all of those, we definitely see that. Your second question, I think, again, if you could just repeat, and then I'll.
If I can address the M&A one, which is an extremely important point, and I don't want us to skip it. Spac is extremely flexible when it's about M&A. So to Jeff's point, many entrepreneurs are coming to this SPAC choice because they would like to add 2, 3, 4. To be honest, in our experience, we've seen 7 companies that would like to be merged together at the moment of the combination. And there are 2 different ways. Either literally 7 companies become, they unite to become public at the combination, or they take care of the acquisition agreement of all the 7 companies in this example ahead of the combination, and thus only one company becomes public together with through the SPAC instrument. It is extremely interesting to go through a process like this because you hear the management team for each one of the M&A participants targets that they have their own dreams and they would like to get to a larger company that can become public. But in the same time, you'll have to deal with most of the time with 7 audits and making sure that the due diligence is properly done. So it's much more complicated. The easy way is one company, one due diligence, one audit that becomes public via SPAC at the moment of the combination.
And since it's the director's exchange, let me just make this point that the more complicated the de-SPAC transaction, the more expensive this insurance becomes. So in the best case, it's very simple, and the go-forward operating company, the cost to protect the directors that are now on that board looks like a mature public company. But as you increase complexity and you have pipes and roll-ups and things like that, you're now going to start listing towards IPO pricing.
Yeah, and I should emphasize here again, while we see a number of situations where there is sort of this role, and again, going back to why you might think about doing a SPAC as opposed to some of the other alternatives is because you're trying to have complexity and you have a model that creates that flexibility. But precisely because you also have complexity, you're now looking at multiple sets of audited financial statements that need to be prepared, getting, and put through the proxy review process with the SEC. So you're adding complexity. Sort of the second question, which was what happens when you get to the end and you're not there? Well, first of all, as I said, all the cash that sits in the trust account is 100% redeemable. So worst case scenario, what you're doing is you're handing the $10 plus the 12 bips of interest that's accrued back to all the public stockholders. The sponsor who's put in his 3 to 5% of capital is out that capital. And you call it a day, and we see that. It doesn't happen that often. It will be interesting to see what we're looking at in 2 years from 2020, where if I sat here in the summer of 2017, there were 33 SPACs. The number of SPACs of those that did not get deals done and wrapped up ended up winding up. I can think of 2 off the top of my head. Maybe there was a third, but not a high percentage. Today, where there's 150 some odd SPACs, and we're adding, this week we'll add, so far this week we know of 11 that are going to get added. I can't say what we're going to be looking at in a couple of years time frame, but that is sort of the process. The other process, as I said, is you can get to the end of your period, and there are mechanisms for being able to go back to the public stockholders. It will cost you something, but go back to the public stockholders and ask them to extend the time so that you can continue looking for targets.
I'm going to try to run through a couple other questions. I have one narrow one, which maybe Priya, you can answer. It's like having all the regulars at our SVDX events, and I'm seeing great questions come in. I'm sorry we won't get them, but this one came from Jack, which is, in this environment, you have forward-looking statements, right? Which you really can't do in an IPO typically. So it feels like there's a different delivery of information, which would imply an increased risk of litigation, but it doesn't seem to bear out. So maybe I'm missing something. This came in a couple different questions. Priya, is there
so when you speak, you create a risk of litigation. Absolutely. And I believe that litigation is on the horizon. And that's why I really want to emphasize, we talked very specifically about insurance for the SPAC IPO. That is not the show. And as Raluca and Jeff have really emphasized, the show is the search and then the de-SPAC transaction. So there is just no doubt that is where all the litigation has come to date. And people who are overly optimistic in their forward-looking statements will pay the piper just like mature public companies do.
Great. And so we've heard kind of a summary. There's a tremendous amount of flexibility. Certain costs are less. We'll see about the future, but certain costs are less. There's a certain speed advantage under certain circumstances. So a couple people said, this is a brilliant vehicle. Why isn't this like even booming even more? What are the drawbacks? I would think, Jeff, you kind of laid out this extraordinary climb, and Clavia, you've also kind of highlighted that. Let's do a quick poll about people's sensibilities around the SPAC environment right now. Let's get everyone's opinion, because as it happens, some of us who've been doing this for a while, a year ago when people said SPAC, we kind of had in the back of our head the SPACs that led to lots of litigation. So let's differentiate that maybe. So I think this is a serious frothy bubble in the SPAC. There is a serious frothy bubble in the SPAC space. Okay, so you can agree, strongly disagree, strongly disagree. Let's see what people think. We've got most all of our participants still on board here for our last 8 minutes. And then I'm gonna kind of ask that set of questions to you guys about, what is froth, what isn't froth, what's going to distinguish. Okay, so yeah, we're favoring that. Yeah, there's definitely something going on here. It feels frothy. It feels a bubble. Maybe I can get.
I want to know who strongly disagreed.
So that's a successful sponsor, perhaps. I don't know, right? We will see. You're not shorting the market. So let's get some opinions in here. Hey, Clavia, you haven't spoken up for a few minutes. Do you want to give us? You have to be careful because of your job. I get that, but talk to us about when things get exciting.
Thanks, Raluca. I see you laughing at me, Raluca. That's a good thing about having a camera. Thanks.
So
Sorry, I interrupted you. Yeah, go ahead.
No. Give us what you can about this. Like you're experienced at this, and things happen in cycles, and people get excited. It's the nature of some of this market behavior. But maybe what do you think about it, and where does it? What can people who are maybe investing, right? Because there's one of the questions: is there money to be made as an investor in this? How should I think about that? Like, what would you give as guidance to keep level head in an environment that might be getting kind of frothy or heated?
Yeah, I'm going to be very careful here. So I'd say, look, the role of the exchange is to ensure that we're protecting the investor. And that's why I've got a business development team that I head up, and the business development effort that my colleagues are very much involved in. And then we've got this side of the business called the regulatory side. And Jeff and his teams work with that side. And the regulatory side is separate from us. They are ensuring that the SPACs, IPOs, direct listings, that they're meeting the regulatory requirements that the SEC wants us to mandate. And there's a very clear line where the SEC has rules in place for types of companies that can go public, what those requirements are, and the various exchanges under the guidelines of the SEC have to interpret and implement those rules. So there's a process to protect the investor. And so we've got this done for several decades with SPACs, and we think we're doing a great job. We are going to continue to enhance the offering and the rules around SPACs, and we made some changes this year earlier that were key, and we asked the SEC to allow us to defer, for example, the initial listing fee to year 2 to help the sponsors. We've got another few plans in there, including making some of our unique investor relations services available earlier in the process, so during the business combination process. And Nasdaq's fairly unique because we own our investor relations resources. So we're going to continue studying the SPAC market and studying the IPO market and seeing how we can continuously enhance through our offerings the experience for public companies. When I look at questions around frothiness or levels of investment, I'd say everyone should seek their own kind of investment guidelines and seek investment advice from those people that are out there making those calls. I think there's a lot of tremendous opportunity there. The U.S. marketplace, along with the global marketplace, has invested considerably in assets that are privately held. Certainly, historical IPO levels are much lower compared to the early 90s. I see Jeff nodding his head. It was not abnormal to have multiple hundreds of IPOs a year. But then kind of the issue was how many of those entities could last as public entities, right? How many of those companies remained past year 5? And so we've done a great job of protecting the investors and putting in mandates and metrics in place so that you can continue to stay listed. And we think that certainly that has evolved. You're not making judgments based on eyeball views. You've got companies that are near to getting revenue or close to profitability in many cases that are going public. So, there's certainly an emerging theme that you're seeing, but disruptive companies, may continue remaining pre-revenue into the IPO process. But we've got the guidelines and the protections in place for investors to make sure that there's an ecosystem that continuously works and everyone's safe.
Yeah, so just chiming in on this, I think, first of all, sort of embedded in the question that you asked, Dan, it really needs to be broken out into two pieces. One is the IPO of the SPAC. The other is the merger de-SPAC process, because they're really, functionally two different things. And I think there's different considerations in both of those. But sort of picking up on some of the things that Flavia talked about, and if I just sort of look at historical trends, I mean, I've been doing this for enough decades now that I remember what the world was in the early 90s. I remember what the world was in the dot-com boom, and I know what the world's been like over the last 6 weeks, 8 weeks. And if I go back enough decades where, once upon a time we may have had 7,000 public companies, and probably not all of those needed, should have been public. And I fast forward to today where you have 3,000 public companies, and I look at sort of, once upon a time, a company with $100 million of revenue was a company that you thought was a public company or ought to be a public company, and maybe had a market cap of 500 million, 750 million, or even $1 billion. And I look at the period of 2006 to today, let alone, but even if I focus in the 2016 and 2019 timeframe, those companies didn't become public. And that's part of the reason why you see a rise of SPACs. And so if I take the number of companies that are out there that probably have private capital invested into them, and I've seen something on the order of magnitude of $2 trillion. And I think about even with the rush of SPACs that we've seen today, raising capital, and there's 33 billion or 35 billion or whatever it is this week in capital sitting there, there's a huge mismatch. And so I don't see an overpopulation of cash chasing the deals that are actually real viable deals out there. So we're nowhere close to a bubble from that standpoint. Having said that, there's no question that there are probably people who are raising SPACs today that probably shouldn't be, and there are probably deals being done today that shouldn't be. But the way that the de-SPAC process works with raising capital from a PIPE standpoint is such that the public markets tend to be pretty efficient in terms of who's actually going to get out and who doesn't. And so, and you layer on top of that the regulatory issues that Flavia just talked about, I feel pretty comfortable with where we are.
So let me do a couple administrative notes, and we're going to wrap it up with one final quick round question. So first, the PowerPoint that we saw at the beginning is available. We'll make that available to everyone. Priya has offered to give the 5 pillars documentation to everyone as well. We may throw in a couple other things, so please be on the lookout for that. When we wrap up, also there's an evaluation. We'd love your feedback. We always try to make changes and improve things. And I am obligated to thank DLA Piper for sponsoring this. This was a really wonderful session, and it was great to have you as a partner, and we appreciate the time you took in pulling everyone together, and really like that. And of course, I'm always so happy to get experts like Raluca and other players like from NASDAQ and Flavia, and of course, Priya Chair Huskins, who is a regular at this and all sorts of wonderful events with Woodruff Sawyer. So thank you very much, especially DLA Piper. Here's my final question, and that is, what one thing do you think is going to be either very, very interesting in the next 6 months, surprise us in the next 6 months, or a person in this ecosystem, investor, target, whatever, should do? Something short. So if you're looking for, you as experts paying a lot of close attention, next 6 months, what's a surprise? What's something that we should do? Just something that's kind of insightful, maybe not as obvious to those of us who spend a little time looking, not just living in it. So I'm looking at Raluca, because Raluca thinks about this a lot, obviously, and lives it. But what one thing would you suggest? We've got about 90 seconds. I'd love to run you each through 20, 30 seconds of an answer.
Sure. So you mean everything else besides the election right in front of us? I would assume that.
Right.
Yeah. So from a sponsor group, what's the most important is to make sure that, considering this explosion of SPACs, we are extra careful about advising and making sure we're taking targets that are ready for the public market. Super important. Should not be any surprises there, and I'm sure both Jeff and Priya would agree with me for that. The second one, from the target perspective, they have to be ready for the public market. It's completely different environments, completely different challenges. There are completely different challenges for that. And there are so many companies that are ready for the public market, but they really have to bring everything together and get the team ready to confront completely different set of investors, completely different set of requirements for the public market.
Fantastic. I'm going to stop there. I'm going to stop you there just so we can have time to have everyone. But that's the perfect two takeaways. Clavia, you're up. What do you think? And you're
So just the outlook on the space, right?
That's perfect.
Yeah. So glass half full. We think that, you know, with more players getting involved on the sponsor side, really diversification across venture capital, family offices, private equity, former operators, serial stockers, we're going to probably see continued, but it's going to be the survival of the fittest, especially if the marketplace does, you know, have, you know, some correction or whatever could happen in the marketplace. Just like anything else in life, you have to be able to show that you've performed, that you've got the knowledge base, and certainly can get a deal done. And I look at Raluca and her team at Gig certainly as being leaders in that space. There's things that they've done that others, frankly, first-timers, they'd be up against, right? And the credibility that someone like Gig brings to the table or other firms bring to the table that have done this multiple times and have had multiple exits is very different from a first-time sponsor. And I think that's very important to keep in mind. But again, I think the thematic approach of a SPAC and launching a SPAC and having a theme around a sector, rather, I think is going to be one to continue to monitor.
Thank you. Priya, and then Jeff.
So my surprise is I think I'm going to continue to be surprised by how many of these SPACs go out. I am surprised. I do think it's a bubble. We talked about the really white shoe firms that have been in the space, are very good at this. You know, Woodruff Sawyer, one of our early ones was Social Plus Capital. We've done all of their IPOs. And there is a range, as we discussed, for Lucas Firm included, that are really, really high quality. I am also starting to see, I'm going to use, what is the phrase, Bush League? Like there is definitely, we're starting to see people get into this space. And I don't mean family office. We've seen a ton of that. That's legit. But people who are, you know, asking me about insurance, but also simultaneously wondering what the 4 letters in SPAC stand for. So I am concerned about that. I will not be surprised to keep seeing it. And in terms of what to do, and this is at the directors in the office, do your diligence. You know, Jeff said it so well. It's all about the deal flow. Raluca proves that every day. And I love how Clava said it's survival of the fittest. Be on the right ship as you're going through these treacherous waters. Do your diligence.
Thank you, Priya. Jeff, you get last word.
Sure, and thank you, Dan. I think the main thing from an outlook standpoint to really sort of think about here is what we've already been experiencing, which is, and I think will continue to be, which is a rapid maturation of this marketplace that includes differentiation of who's playing in it at all levels, whether it's at the sponsor level in terms of the deal flow, where the sources of capital are coming from that are ultimately flowing in both into the IPO and into the business combinations, and how that capital flow and capital market is going to really sort of adapt to the fact that there's as many SPACs out there, and this is what's happening in that marketplace.
Well, I feel like based on the questions, which I know some will try to get private answers to everyone, and based on this fantastic panel and the fact that we went over by a few minutes and feel like we could go on for a long time, I bet we'll have a follow-up. So maybe we'll get to check in on those predictions and those surprises. But thank you all very much. Thanks very much to the audience who stuck with us. We appreciate it, and we look forward to speaking to you all again.